we have found is that in all markets, whether it's US, Europe, Canada, Australia, Japan, India, what seems to work long term, if you want to see how equities are placed, is to look at what is called real return, which is the return above inflation. And the interesting part is almost all markets, this converges to let's say about 5 to 7% above inflation return on a 10-20 year basis. This data will not work on 2-3 year basis. But if you're looking at 10, 15, 20 year basis, uh, as you can see with this chart on US returns over the long term, it always converges to somewhere between 5 to 7%. And on that metric, if you see India, near term is a bit overvalued. So when I say near term, it is 3, 5, 10 years. So let's say the 10-year real return is about 7.2%, which is above the 6.5% average. But on 20-year basis, it's actually closer to fair value. So clearly, from a long-term perspective, there is nothing much to take a strong stance in terms of being fearful or being greedy. Uh, you can argue that as a contrarian or value investor, is this a good market? It obviously is not, because obviously equities at times goes below fair value. But having said that, what we feel is from an asset allocation viewpoint, it would be not a correct thing to be defensive on equities, because sometimes valuation is only part of the landscape. We also have to see the what is the macro context, and we feel that the global macro context is going to support risk assets like equity and gold. So why we think that is the second important question, that actually the biggest reason to buy equities is that globally governments have a lot of debt. Now, if you see, apart from maybe Germany, every other country today has government debt, which is more than 100% of GDP. Now, these debt levels are quite unprecedented. Since World War II, probably the globe hasn't seen this kind of debt level. And why this is important is, if we just take the example of Japan, which hit 100% debt to GDP about 20 years back. And I think it's important to look at what happened there as an example of what may happen globally. Uh, One is that obviously Japan has had structural issues in terms of demographics, which has slowed down debt. So the only choice for Japan when the debt became very high for the government was essentially to keep interest rates very low versus inflation. Why this is needed is basically, if you think about it, for governments, tax revenues are broadly linked to nominal GDP, which is linked to inflation. So if you keep inflation high, tax revenues will be high. And if you keep interest rates low, obviously your interest cost on the massive amount of debt you have will be less. So if a government has very high debt, then the interest rate has to be low versus inflation. So what we call real rates, which is basically your real interest rate, your interest rate versus inflation, the real interest rate has to be zero or negative. And the other thing is that since the debt was so high, the Japanese central bank has kept buying the government bond, in a way monetizing the debt. So more than half, or not more than half, about 40 to 50% of government debt of Japan is today on the balance sheet of the central bank. Now, essentially, this is very loose monetary policy, and the consequence has been that if you see over last 2 decades, uh, the yen has lost 90% against gold. It has lost 30% against dollar, and also if the asset allocation is not in equities, the issue is that even though growth was not great, GDP growth has been about 1.5%, inflation is 1.5%. But stocks have returned over last 10 years about 10% CAGR, compounding. So the point here is that when monetary policy is very loose, the return may be in equities may be much higher than the 5 to 6% above inflation, what we normally see, which is why we are saying that given that globally, almost all big countries today, US, Europe, Japan, etc., they are at unprecedented debt levels. We feel that we have to be bit more aggressive in equities than what is dictated by the valuation. So even if valuation is slightly above fair value, we are saying that we should be reasonably allocated to equity gold. So if we see the government, what can they do to get the debt down? Uh, One is the best ways, of course, to improve productivity and increase real GDP. But that is possible only in the long term. It can't take care of the next 1 to 5 years. Also, with demographics, it's very difficult to change demographics, right? Um Second is increase inflation, which they will not do straightforward, but by central bank buying bonds, in a way that will happen. Reducing expenses is obviously in a democracy very difficult. Increasing taxes also difficult, and also today lot of the HNIs can move countries if taxes go up. So the consequence is that you can reduce interest rate, which is the only big choice. And therefore, it's not only equities. We think international equities, gold, Bitcoin, all these assets will be uh, at healthy levels as long as this debt issue is not tackled by the government. And if it is tackled through uh, loose monetary policy, then all these assets will continue to do well. So this is why we are feeling that equities will do pretty okay, even though valuations are not cheap. Specific to India, again, the big point here is not growth, but the fact that uh, from a currency perspective, our current account deficit is looking in the best shape probably since independence. Because, and this we've said multiple times, basically last 10, 15 years, we've seen a remarkable improvement in India's current account deficit. Essentially because our biggest export services has done well. It has become 4-5% of GDP from 2-2.5%. Because post-COVID, there has been a lot of remote work which is outsourced to India. So the global captive centers, what we call GCCs, they've done pretty well. Our biggest import is oil, which again, thankfully, prices have been very weak. So from 6 to 8% of GDP, it's down to around 4%. Which basically means that current account deficit has become almost zero, which has never happened in the last many decades. Also, the other issue is we've obviously maybe at the cost of growth, but we've got inflation down. And not only has inflation come down, the volatility of inflation also has come down. So just like for a stock, if volatility is low, we give higher price to earning multiple. As a country, if we are able to achieve inflation with low volatility, then our risk premium, basically our cost of equity, cost of debt will go down and PE multiples will go higher. So combining it with current account and inflation being under good control, we think next 5-10 years, our PE multiples will remain higher than the last 10-year average. So we are not of the view that uh, the PE multiple needs to converge back to historic averages. We think it will remain at anywhere between 10 to 15% higher than historical numbers. Now, coming to growth and why we think small caps will continue to outperform on a 3-5 year basis. See, first of all, growth is going to be difficult because, simply put, demographics is very adverse, and demographics obviously can't change quickly. So, if you see most of the regions in the world, which is anything which is not blue in this chart, is essentially population close to peaking out or already peaked out. And even India, while at country level the birth rate is okay, but when you see the richer states, the birth rates are materially below two. So the south and west states, which are the more prosperous states in terms of GDP, they will start to degrow in next 3 5 years broadly. Um, so if you see total number of students in Indian school, actually that has already started coming down over the last 2 3 years. So that seems to have peaked out structurally. And these kind of demographics obviously will impact growth. Other reason why growth is likely to be soft is we all read the headlines nowadays that tariffs and protectionism is rising. So between 1980 to 2010, we had a golden age of free trade. That seems to be obviously behind us. And this will also impact growth because free trade is more efficient and therefore good for growth. Uh, Clearly, when there is a lot of protectionism, there will be a negative impact on growth. Why we like small caps is generally, first of all, if you see long-term data, in most countries, uh, mid and small caps outperform large caps. So in this chart, if the bar is on the right, it essentially means last 20 to 100 years, basically in these countries, mid and small caps have outperformed. And you will see that about 80 90% of countries, mid and small caps outperform. But also because we think Nifty 100 earnings is unlikely to be anything interesting in the next 2 3 years, basically because we're coming off a very high base. So typically what happens is in the very long term, Nifty 100 earnings converges to Nifty 50 or Nifty 100 earnings converges to nominal GDP. But there are cycles, there are periods where the earnings will lag nominal GDP. There are periods where earnings accelerate ahead of nominal GDP. So today, on a 5 year basis, we've already seen Nifty 50 earnings outperform nominal GDP by almost 10%. So nominal GDP has grown at 10%. Nifty 50 earnings have grown at 20%. Of course, coming off a weak COVID base, but still 5 years is a fairly long period of time. And we think next 3 4 years, we should assume by reverse percent below nominal GDP. So somewhere in the 9 to 12% range is where we would think that Nifty 50 earnings would settle at. And for that, the versus the valuation, we don't think large caps, they can give you steady compounding around that nominal GDP number, but unlikely that earnings will surprise positively at aggregate level, which is why we also prefer small caps. In terms of risks, what do we see? I think from a global perspective, the biggest risk is that the 30-year bonds are trading at very high levels. Now, the assumption is because of monetary easing, interest rates coming down, and central bank buying bonds, these bond yields will come down. But as of now, they're high, and if they go up, we think that equities will struggle to perform. So if you see in US, the 10-year yield is around 4, the 30-year yield is 4.6, 4.7. In Japan, the 10-year yield is 1.6, the 30-year yield is 3.2. Even in India, there's a fairly big gap between the 30-year yield to the 10-year yield being 6.4, 6.5, and 30-year yield at 7.1, 7.2. So globally, the 30-year yields are definitely high. And as I said, if they go up further, then it will put pressure on equities. From a domestic angle, we think the structural risk, which is the biggest, is actually AI, which will play out through the services exports, because we are already seeing that coding effort has reduced dramatically because of AI, which is why a lot of the IT services companies are struggling. Now, if the GCCs also get impacted, and last 1 or 2 month number growth has been a bit disappointing, but again, this is obviously very short-term data to take any conclusion of. So we feel at this point, services exports will continue to grow at least 5 to 10%. But because of AI, if the impact is very high, we have to be careful, and that will impact India's economy quite significantly if AI first takes away a lot of jobs. Although finally, most of the times, new technologies have ended up creating jobs on a net basis. But obviously, there can be time gap between jobs reducing and then jobs getting created. So this we think is the big risk on the domestic side. On the domestic flows, see, globally, as I said, we think liquidity will be very healthy given that governments, because of the debt levels, will run low interest rates. On the domestic side, also we feel that the flows will sustain at these levels largely. At least they may obviously go up, but we don't see a big risk to the flows coming down. One is, if you see the household balance sheet, if you see urban real estate, gold, bank deposits, and equities as the four important asset classes, there's roughly about 1,000 lakh crore of assets. And gold, actually, this data is about 3 4 months back. So today it is actually almost 325 to 350 lakh crores. Uh, and that has been an addition of roughly about 150 lakh crores at least in the last 2 years. Now, against this 1,000 lakh crores, approximately the total borrowing for house loans, auto loans, and the MSME borrowing, which is largely retail, is about 100 lakh crores. So there is assets are about 5 times of liabilities for Indian households. And equities is still the lowest allocation in terms of assets. So first of all, on the balance sheet side, we don't see a problem of equities moving up in proportion to the overall assets. Even on a flow basis, if you see bank deposits, gold, and real estate only tops in cities is roughly 5 lakh odd crores. Uh, Obviously, if you count commercial real estate and all the other cities, it will be much, maybe 2 or 3 times this number. So right now, the mutual fund inflows are roughly about 5 lakh crores per annum, which again is among the lowest of these four asset classes. The other issue we also feel is that there is a lot of savings account balance in India, which can move to hybrid or arbitrage or ESF. So if you see savings account is obviously a very, very low return product. There is about 70 lakh crores sitting in savings account. And if you see with apps and financial literacy, people I think are getting more and more aware that the post-tax return on these saving account balances are very, very low versus other assets. Which is why if you see the big cities, the growth in savings account is has come down to almost negligible levels. And I'm sure a lot of this is going to move to uh, capital market products. May not be full equity funds, but a lot of the asset allocation funds like BAF, MAF, ESF, arbitrage, etc. So we do think that domestic liquidity is largely going to be healthy for equities. So just overall, just to summarize how we are feeling about asset allocation, uh, markets are at fair value on a 10-20 year basis. But as I said, given that fixed income globally, you're not likely to make any return versus inflation. We think one should not under allocate to equities. Also, since real GDP is not likely to be high and liquidity is going to be okay, I think the thematic products where even in low real GDP environment, the companies which can grow faster, this typically happens in small cap, innovation, and financial services kind of funds. I think one should have a fair amount of allocation to them. This may need patience because last 3-5 year returns have obviously been very high, and we've gone through 1 year of time correction, but that may go on for some more months. But we do feel that one should have a slightly medium to long term view on these funds and own a fair bit of them. Uh, at a global level, I think emerging market and European equities are relatively cheap compared to US and Indian equities. Apart from US tech, which is a different segment altogether. But I do think that in terms of expectations, there's very low expectation from Chinese and European economy, and the stocks therefore are very cheap. They may outperform in the near term because while India is obviously the stronger structural growth story, the valuation tend to be expensive. I feel that from asset allocation perspective, it's good to spread your bets because nothing is honestly cheap. But if monetary policy globally is going to be loose, then we need to diversify with gold, silver, and some US tech also. Um, I think another good asset class to own is the 30-year bond. As I said, unless 30-year bond yields come down, it does look like risk assets will struggle.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.